The government has two weapons to control the economy, and right now both are failing. Fiscal policy is what the government does with taxes and spending. When the economy is slow, the government can spend more money on roads, schools, and programs to create jobs. Or they can cut taxes so people have more money to spend. Monetary policy is what the Federal Reserve does with interest rates and the money supply. When inflation is high, the Fed raises interest rates to make borrowing expensive so people spend less. When the economy is weak, they lower rates to make borrowing cheap so businesses invest and people buy homes. Here's the problem in 2026. The U.S. national debt just hit $38 trillion, which is 120% of our entire economy. This means fiscal policy doesn't work anymore. When the government spends money, it has to borrow so much that interest payments alone cost over $1 trillion per year. That's more than we spend on Medicare or the military. And monetary policy is broken too. The Fed wants to lower interest rates to help the economy, but they can't because the massive debt means lower rates just make inflation worse. Former Treasury Secretary Janet Yellen warned we've entered fiscal dominance, where the debt is so huge that traditional economic tools stop working. It's like trying to steer a car when the brakes have turned into an accelerator. Economists say America has less fiscal space than any time in history to respond to another war, pandemic, or recession. We're trapped. We can't spend our way out, and we can't cut interest rates without causing more problems. This is why America's economic future looks so dangerous.